Welcome students. Welcome to our module 2, that is again it's a continuation of our introduction to the option market. This is also a basic or introductory level for our students. Here in this module, these are the things which we are going to cover, like what is moneyness in options value, what is time value options, and what is the importance of time value and how it has been calculated. There is a brief overview of options Greek, that's a Greek options we call them as. Then there is a concept of option trading. What is the difference between exercise and the square of? We covered this thing in our module 1 also, but we are going to revise here this particular point. Then the benefits of option writing, then what is the cost of carry, and few future strategies here in this module 2. So we already know that what is option. In a simple way, we say that option is a contract to buy or sell of a particular underlying. Like we can say it is a type of a derivative trading where the buyer of an options contract reverses the right to purchase the underlying share or the index, but he is not bound to buy it, that is, he has no obligation. So on the other hand, the seller of an options contract has an obligation to sell the share or the index at the contracted price, but he has no right to refuse the share or the index in case of buyer demand. In India, options are available in some of the selected shares only on the handful of indexes which has a very high liquidity. So first we are going to understand what is moneyness in options value. These are the basic things. Like before we move ahead, what is the moneyness in options value? First of all, we have to understand what is the strike price. Though we have covered this strike price in our previous module also, but here we are just going to revise it. Now strike price, it is a fixed price at which owner or the buyer of the call option can buy the underlying asset from an option seller, no matter whatever is the current price of an underlying asset. Just for an example to make you understand it more clearly, suppose if a strike price of a Reliance call option is trading at 1300, that means buyer of the option can buy Reliance stock at 1300 even if the current market price of the stock goes above 1300. Say even if on the day of expiry, if the Reliance price goes in the cash market goes up to the 1400, 1500 and 1600 level, at any level, but the call option buyer has the right to buy that Reliance share at the rate of 1300. So because he has made a contract with an option seller at the strike price of 1300, so it gives the buyer of the Reliance call option to buy that Reliance at the rate of 1300 even if it is trading at the level of 1500 or 1400. So this is what we call as a strike price. So strike price is a level at which buyer and seller agrees to buy a particular trade or to buy a particular stock. And if we talk about put option, suppose the strike price at which the buyer of a put option can sell the underlying asset to the option seller no matter whatever the price that currently is trading in that cash market. Say for an example, we are taking the example of Reliance again. Suppose if somebody has bought a put option of Reliance at 1300, that means that particular trader or that particular trader who has bought Reliance 1300 put option, he has a right to sell that stock of Reliance at the level of 1300 even if the current market price of that stock is lower than 1300. Say even if the stock is trading at some 700, 800 or 900 level, even the current market price is 900 level, but since he is an option buyer, he has a right to sell the option or to sell the Reliance share at the rate of 1300. So this is what we call a strike price, and the strike price are the level which is defined or which has been calculated on basis of few parameters by NSE or exchange. So this is we call as a strike price. So now we move ahead for the moneyness in options value. Now there are basically three types of moneyness in it, like we call them as a ITM, ATM and the OTM. Now what is The ITM. Now ITM is simply, we can say, is a call option that is a in the money if its strike price is below the current market price of the underlying asset. For example, if you bought 400 strike price of Nifty call option and Nifty is trading at the level of 4200, the call option is called the in the money. So if you take an example, suppose Nifty current trading price is 4000 rupees, 4210, and we are going to make a trade at the level of 4100 strike price, then if it is called as a in the money call option. In case of put option, suppose if Nifty is trading at the level of 5230, and if we buy a contract of 5200, then it will become a suppose we just take say suppose Nifty is trading at the level of 5230, and if we buy a put option of 5300, okay, at the strike price of 5300, then the 5230 level would be our in the money option. So now let's move on to the moneyness in options value. This is moneyness options value. There are basically three type of moneyness in options. One is called ITM option, second one is called OTM option, and the third one is called the ATM option. If we just understand its full form, what it's called, first one is called the in the money option, then it's out of the money option, then it's the at the money option. There are basically two categories of it. One is called the in the money call option, and then is in the money put option. Now understand what is in the money call option and what is in the money put option. In a simple way, a call option is in the money if its strike price is below the current market price. If its strike price is below the current market price, for example, if you bought a 4000 strike price Nifty call option, okay, and Nifty is trading at the level somewhere around 4120 or 4200 or 4200, anywhere above the level of 4000, means any value which is above the 4000 value, 4000 strike price, then our call option in Nifty would become a in the money call option. So in a simple way we can say, if the current market price is greater than our entry price of strike price, is called our in the money call option. And same way, if we talk about put option, the position would be the reverse. So a put option is in the money when its strike price is above the current market price of the underlying. For example, if somebody bought 5000 Nifty put option and Nifty is trading somewhere near somewhere below 5000, could be anywhere 4900, 4950, 4980, 4960, means every value below 5000 Nifty strike price would be our Nifty put in the money option. So in a simple way we can say, if the current market price is below the strike price or is less than the strike price, is called our Nifty or is called our put in the money option. The next is OTM. Again there is a two category, OTM call option and OTM put option. Now OTM call option is out of the money option when its strike price is above the current market price of the underlying stock. For example, if you bought something or if you bought Nifty 5000 call option, means 5000 is our strike price and Nifty is trading at 4900 level. Okay, so the 5000 strike price would be our out of the money call option. The same way it is going to reverse in case of put option for out of the money. So suppose if put option is out of the money when strike price is below the current market price of the underlying asset. For example, if you bought 5000 Nifty put option and Nifty is trading at the level of above 5000, say anything above 5050 or 5080 or 5100 or 5200, so any value above the strike price would be our Nifty put option for out of the money option. Okay, so just take here in another example, just not to confuse you, just we are taking another simple example. If Nifty's current market price is 5280 and if we bought 5200 strike price of put option, means we have bought Nifty out of the money put option. So this is a simple example of understanding what is out of the money option for call and what is out of the money option for put. Now the next one is at the money option. What is at the money option? When current market price is equal to strike price is called at the money option. It's a simple to understand. At the money option means when current market price becomes equal to the strike price is called the at the money option. Now another important thing, what is an intrinsic value of an option? Now what is an intrinsic value? Now intrinsic value can be defined as the amount, or we can say intrinsic value can be termed as a value which a strike price of an option is in the money. So intrinsic value can only be applied when the option has a in the money value. So some people also view it as a value that any given option would have if it were exercised today. This is a minimum value or the base value any option can have at the time of expiry or when somebody wants to exercise. So this is called intrinsic value. For call options, the intrinsic value would be current market price minus strike price. Say suppose if you want to calculate the intrinsic value of XYZ stock, say suppose the intrinsic value can be calculated by taking the current market price minus the strike price. Suppose if somebody bought for call option of 5, strike price is 5000 and Nifty is currently trading at the level of 5180. So current market price is 5180 and somebody bought 5000 strike price. So 5180 minus 5000, then the intrinsic value of that particular Nifty option is 180 points. So 180 rupees, we call them as a intrinsic value. Again for the put option it is just reverse. So intrinsic value is equal to strike price minus current market price or the current stock price. So if we want to calculate the put option value, for the put option value of intrinsic value or the base value or the minimum value would be, suppose if market somebody bought 5100 strike price of put option in Nifty and market is trading at the level of 4900. So 50, suppose if somebody bought at 4980 is the current market price and they bought 5100 strike price. So 5100 minus 4980, so whatever the difference is 120 or 100 and whatever the difference result, that would become our intrinsic value. So always remember, intrinsic value cannot be negative value. So minimum intrinsic value for any stock could be minimum, it's a 0 for an option. What is the time value of the option? This is an important thing we have to understand. What is the time value of an option? Time value is equal to option price minus intrinsic value. So we have learned what is an intrinsic value. Now we have to understand what is the time value. Let's take an example. So suppose if ABC trading company, if ABC stock price is trading at the level of 110 rupees and the ABC 100 call option is trading at the level of 15 rupees. So premium is always been calculated to us because NSE for every stock, if you want to calculate the premium, that is been we can get it from the NSE or the BSE website or from any exchange. Okay, so premium would always be aware to us. So the premium is equal to intrinsic value plus time value. So every premium has these two components, that is intrinsic value plus time value. So intrinsic value is equal to spot price or the current market price minus strike price for the call. So intrinsic value of that particular stock is 110, that is a spot price minus strike price, that would become 10, and the premium, we already know that 100 call option 100 strike price premium is 15. So the time value would be 15, that is the premium, minus, see here, intrinsic value is the 10, so 5 would become our time value. So time value is something which is going to become 0 at the time of expiry. So if any stock who has a, if any stock in which there is a time value in the premium, so if any premium who includes the time value, that time value is going to be 0 or going to be negligible at the day of expiry. So this is called time value option. Now the next topic is overview of the Greeks option. Now, many option traders mistakenly assume that price movement in any underlying stock or index or security is the only factor driving changes in the options price. In fact, the thing is, it's very possible to watch the option contract move up or down in any value while the underlying price stays still. So when we talk about Greeks, mathematically speaking, then the Greeks are all derived from an options pricing model. So there are plenty of options pricing model available, and the most of the highly used models like Black-Scholes model, binomial, trinomial models, or like Cox, Ross, Rubinstein model. So these are the kind of options model on which value of the Greeks are been calculated. So primarily there are 5 types of Greek options, like one is called delta, gamma, then vega, then rho, then theta. So these are the primary Greek calculations on which a pricing of an options value are determined. So we are going to give you a brief introduction and the brief definition, like how and we have to understand so that these things sound look familiar to you. So we are going to understand here the major Greeks: delta, gamma, theta, rho, vega. So we are going to explore each of these in terms of their importance, explaining how to interpret and use each of them in our trading decision. So first of all, understand delta. Now what is a delta? Delta is the rate of change of options price with change in an underlying asset. Usually short dated ATM call or put delta has 0.5 delta. So just don't get confused. We are about to elaborate the concept of it. One of the biggest mistakes a new option trader makes is buying a call option in order to pick something a winner. But after all, buying calls or buying puts does not necessarily that you are going to, if you bought something, that price of that particular stock is going to up, and if you bought put, that price of that particular stock is going to low. No, this is not how actually the things work in options. So options are a bit trickier. Sometimes the underlying stock moves in the expected direction, but the option value does not move in a even a bit. And the same way happens, or even the vice versa, because the options with different strikes move differently with the underlying price moves up and down, and also when the option approaches the expiration. So there are mathematical way to estimate how much your option price might move in underlying when the underlying set of a particular price moves by 1 point. So we can calculate the value of a movement in option price with the help of delta. So what delta does is it provides a part of the reason for how and why an option price moves the way it does. There are many different definitions of delta. Like the explanation can be a very primary one. Like delta is the amount of a theoretical options price will change for a corresponding 1 unit, 1 point, or 1 rupee change in the price of an underlying security. So suppose if price of a stock, say XYZ stock, for example, if you buy a call option that has a delta of 0.75, means you know that every 1 rupee movement means every 1 rupee movement which triggers the value of an option will change by 0.75 points. So this is how the value of an option can be defined. So keep in mind that delta is determined by using some different pricing models, and we are not going to explain those pricing models because that will complicate the things very difficult way for our students. And furthermore, these things require a rigorous practice and a very kind or very long time of dedication. So it will become very difficult for a retail trader to understand all these concepts and go accordingly in that direction. So this is how we can understand the basic theme of a delta. So suppose imagine a stock, suppose trading at the level of 40 rupees, and we are looking for a month or 2 months of time frame. So at the when we talk about delta, so at the money call with a strike price of 40 and the current price of that current price of 40, strike price is 3 rupees. So if the stock moves from 40 to 41, the only thing that changes in the stock price is how much a price can move from one point when we are talking about the ATM call option in terms of delta. So this is what actually delta does. If a price moves from one point, if a 1 rupee movement happens in the stock price, then how much will it affect in the delta pricing? So that is the important thing which we have to look into for the delta. So we can say delta is dynamic in nature. Generally, people use delta to predict price movement as the expiration nears. Whenever the price of a particular, whenever the expiry comes of any particular stock, they generally people assume that how much will the option value would behave in terms of delta. So this is basically used to check the expiration value. Now the second important aspect of Greeks is called gamma. Now what is gamma? It is a rate, or we can say it's an acceleration factor. Like just go by this understanding here, this meaning. Gamma is the rate that delta will change based on $1 change in the stock, right? So if delta is the speed at which option prices change, you can think gamma is the acceleration factor, that is the rate at which delta will change. So value of delta depends upon the gamma. So gamma is actually the rate acceleration factor, we can say. So options with highest gamma are the most responsive to the changes in the price of an underlying stock. So we can say gamma is the amount, or in a theoretical way, gamma is the concept of delta, how much delta will change for a corresponding 1 rupee change in the price of an underlying asset. Okay, so this is a basic understanding of a gamma. Just suppose we take an example in our day-to-day life, like just like when you buy a car, you may be attracted towards more of a acceleration factor. Same way you are more attracted towards its gamma factor when you're buying an option. So if your option has a large gamma, its delta has the ability to approach 100 quickly, or it's say suppose if the option has a large gamma, the delta will reach the level of 0.1, giving its price 1-to-1 movement with the stock. So always remember, the maximum delta for a future can be 1, would always be 1, and the delta for options would in very rare case would go to 1. So it will always be 1 or less than 1. So for option beginners, this is the three important things we have to understand. What is delta, what is gamma, and what is theta. These are the three important factors we always have to look when we make a option trading strategy, and its effect, like how we are going to find out what could be our possible best strategy in what kind of scenario. So suppose if you are an option buyer, high gamma is good as long as your forecast is correct. That's why, because your option moves in the money and delta will approach 1 more rapidly. But if your forecast is wrong, it can come back to bite you rapidly by lowering your delta value. So if you're an option seller and your forecast is incorrect, high gamma is your enemy. Means, because in case your position to work against you at more accelerated rate, suppose if your option, or if your rate of gamma is high and the condition and your objective and your strategy didn't work in your favor, means if that gamma, if that particular option has a high gamma, means you are going to be into loss, or your price will move very rapidly from in the money to out of the money. So this is very important to understand the rate of gamma, like at which rate the delta will accelerate and at which rate the delta will go against you or in favor of you. So if it goes against you, your option value would lose significantly in a rapid manner. Now, third important one is called theta. It is very important. I think it is the most important factor for any option pricing. We generally also call them as a time decay. So theta is the rate of change of options price with change in time. So the time decay or theta is an enemy number one for option buyer. On the other hand, it is usually the option seller's best friend. So what we know that theta is a time value, and time value is something which we know that at the day of expiry of that contract, the theta value is going to be zero. So we have to understand that theta is the amount the price of calls and puts will decrease, at least in theory, for 1 day change in the time of expiration. So with every passing day, suppose today is the 1st of November and we are making a strategy on the 1st of November and the expiry for the month is 28th or 29th of November. So on the 1st of November, time value in any option would be at the maximum. Okay, and since with each passing day, 2nd November, 3rd November, 4th November, with every passing day, the time value of that particular stock will just keep on declining. Reason being that theta is a diminishing factor. We call them as a time decay. So with each passing day, the value of theta will starts eroding. And at the money options will experience more significant losses over the time or in the money options with the same underlying stock of the expiration, because at the money options have the most time value that is built in that premium. So we always have to be very careful while making any kind of strategy on the basis of ATM options. Now rho, we call them also as a kappa, the rate of change of options price with the change in interest rate. So these have actually have don't have that kind of influence in the market, because in options trading generally interest rate does not change so very often. So it very rarely affect our options pricing. It does, but its effect is negligible. Now, what does an option exercise mean? What is an option exercise? We have already discussed about this in an example. Let's take here, understand it again. What does an option exercise mean? Now, exercising a stock call option means buying the stock at the price set by the option regardless of the stock price at the time of your exercise of the option. Now, in simple way, just take an example. Let's understand it by using an example. Mr. Gupta or Mr. X bought 2500 Reliance call option contract. The stock is currently trading at 3000 level. If Mr. Gupta decides to exercise his right, he will get the stock at the rate of 2500 even though the stock is being traded at the 3000 level, because he made a contract with the seller at the level of 2500. So even if the price goes 3000 or 4000, 10,000 or any number, any hypothetical number, that the seller or Mr. Gupta will have the right to exercise. Exercise means to take a physical delivery of that stock. But remember, in Indian market, physical settlement has not yet been initiated. Only the cash settlement has been initiated. So if somebody wants to take a physical delivery, that is only for the concept of understanding the difference between exercise and the square off. So in Indian market, we can only square off our position. We cannot take a physical delivery in stock market. So this is what actually we mean here by what does option exercise mean. Now, what is the difference between square off and exercise? We just had an example about exercise means to taking a physical delivery, and square off means simply booking the profit This is what we call as a square of and the exercise difference. You can also read in your screen. It is pretty much self-explanatory. You just square off the position, you will book the profit or you will book the loss. That is called simple square of buying and selling. And exercising means taking a physical delivery into a demat account. Our next topic is future strategies. Now, these are the listed strategies in future we are going to discuss in this module. First one is called buying future and buying ITM put option, buying future and immediate OTM put option. Third one is selling future and buying OTM call option. Fourth one is covered call option. Then fifth one is covered put option. Then future calendar spread strategy, buying stock in cash market and sell the same underlying in the future market, which we also call as a arbitrage opportunity. Buying all stocks of an index and short sell the index future. So these are the 8 type of future strategies which we can make in this with the help of option and with the help of future strategies. So let's understand and try to work out how we can make effectively for our trading. The first is called buying future and ITM put option. Now understand when we are going to make this strategy. Like suppose this strategy can be made when we think that market is strongly bullish with a very strong upward view. So what we are doing here is we are buying a future and we are the same time we are also buying a ITM put option. So suppose the type of market would be, this is the classification for this strategy. The strategy point we have to keep in mind, like this can be applied when the market is strongly bullish with an upward view, and the break-even point BEP represents here break-even point, and the break-even point would be our entry price in the future, that is future strike price plus the put option we have bought, and the maximum loss would be future position loss plus the TV loss here represents time value loss, and the maximum profit potential, and the profit potential here in this strategy is unlimited. So let's understand and find out how we can make this strategy. Let's take an example here. Suppose some trader or XYZ trader buys Reliance Industries Limited future at 815 with an upside target of 900 rupees. So what he does is he bought put option. He also bought a put option of 820 strike price at the level of 20 rupees. Since he has an upside view of 900 level, but since it's in a stock market, guarantee there is nothing. He still wants to hedge his position. So what he does, suppose in case kind of any problem could be of any market sentiment change, that price of that Reliance may fall on the downside also. So what he does, he just took a risk just to save his position or just to hedge his position. What he does is he also bought 820 ITM strike price for Reliance at the level of 20 at the rate of 20. Considering the lot size of Reliance, that is 250, the amount invested in that strategy is equal to 815 into 250, that is 2,03,750. Since we are trading in future, we are not supposed to pay the entire amount of 2,03,750 something. We just have to pay the margin, and the margin is something which generally depends from stock to stock. It varies from 10% to 40% depending upon the category of the stock and the liquidity involved in that stock. So what a trader does here is he bought Reliance future at the level of at the rate of 815, and at the same time he bought a strike price of 820 call option, put option at the level at the rate of 20 rupees. So this is his total investment, that is 2,08,750. Now since at what level his break-even would be achieved, his break-even would be when the price of the stock would go above 835, then the trader would start making the profit. So this is one way of trading is in future. Now here are the situations referred here. Suppose if future price closes at 790, then the loss in the future Reliance contract would be 815 minus 790. That is because he bought at 815. If suppose market goes against his strategy, the loss he has to bear in future contract is, that is 25 points, means 790 is the closing price. So if market or Reliance future expires at the level of 790, then 25 points would be his loss in the future. And the put option he bought at the 820, and if Reliance expires at 790, so the 30 would be its base value, since 820 is the strike price and 790 is the closing price. So 30 would be the base value. So the net gain in the put option is 30 minus 20, that is equal to 10 points. So 30 point is the base value which a Reliance trader will eventually get at the time of expiry. So the net impact on the position would be future loss minus option gain. So 10 point would be the net loss in case it doesn't matter whether price closes at any level. So if anything beyond the level of 790, or even if the stock closes at 600 level, his loss would not be more than 10 points. So this is how we can say we are hedging our position. So this was the situation 1. Now the further situations here is situation 2, situation 3 and situation 4. We just have to keep the value in place and just find out what happened in case at what level if the price closes at that level. So suppose if price of a Reliance future closes at 815, then the maximum loss would be only the put option of the premium value which a trader has paid. Okay, so that would be the maximum loss. So the maximum loss happens when the price closes at the ATM level. Now considering the third situation, if the price of RIL future closes at 830, then our loss would be of only 5 points. Okay, because 15 points would be the profit in the future, because we bought future at 815 and it is closing at the level of 830, and we bought 820 strike price level, and since if it closes at 830, okay, so our entry price for the option was 20 rupees. Since it's an expiry at 830, so it will expire at the level of 0 rupees. We are not getting anything in paid. So 15 points profit in future and 20 points loss in option. So the net loss would be of only 5 points. Now if the Reliance future closes at 835, we would be at no profit, no loss situation. So if Reliance starts moving above 835 level, then only in that case we will start getting into the profit. But one thing happened here is, even if the Reliance does not move over 835, but what happens, it just keeps on going again down and down and down. So suppose come at the level of 750, 720, 700 or any level, but our loss would be the maximum of 10 points here in this case. So this is how what we call as an option strategy, or we call as a hedging. So this was our first strategy we just explained, that was called buying a future contract and buying a ITM put option. Now the next strategy here is buying future and nearest OTM put option. Now when we are going to apply this strategy, when market sentiment is bullish, not strongly bullish, when we see that market any particular stock is trading in range, or maybe some with upward bias, there is not a strong trend for the bullishness, that like suppose we take an example of previous example of Reliance, that we were expecting that market would be extremely bullish. Here in this case it is bullish but not that extremely bullish. So what we are trying to understand here is, we are going to apply this in the market sentiment when market is bullish, and the break-even price for that strategy would be future price plus the option price, future price plus the option price, that is put option. The maximum loss in this case would be the future loss plus the put option premium, the time value, and the profit potential here in this case would be unlimited. And the scenario here is, suppose somebody bought RIL future at 815 with a lot size of 250. Taking just a previous example, investment required would be, that is again 2,03,750. Then bought 810p. Since we are buying OTM put option, current market price is 815 and 810 would be the OTM put option, that is 15 into, that is the lot size, that is 3750. So the maximum loss in the future is when the future closes at the put strike price. So that would be the case for the maximum loss. So here this is how we are going to understand when we are seeing, or how we are going to calculate the maximum profit, and how this is the way we are going to calculate the maximum loss. Next strategy is selling future and buying OTM call option. This strategy is applied when market is bearish, or we can say market is extremely or strong bearish, and the break-even point in this case would be future strike minus call premium, and the maximum loss would be the future loss plus the time value, and the profit potential in this case would be unlimited if we are trading into this strong bearish market. Now understand how we are going to do it. This is just a opposite of a strong our previous strategy which we just discussed. Here in this case we are expecting the price of a particular stock will fall significantly, but since we are not sure that how, at what level, or maybe there might be occurrences that our expectation and our sentiment and our strategies might fail. So just to control that position, and just to control ourselves from the strong risk, we are going to hedge our position by buying the OTM call option. So this is pretty much self-explanatory. If you just follow the previous example, you just put the value here and you will be able to find out like how we are going to and how we are going to make the strategy, and what are the important things which we have to look into. Now the next strategy is called covered call option. Now what is a covered call option? It is simply buying future and selling ITM call option. It is used when market expectation is range bound to mildly bullish. We are seeing that market is trading in a range, but there are chances that it might go up. So in this case we have to find out the range of the market, and we have to make a strategy which may see that there is some limited upside potential, and the break-even point can be calculated from future price minus premium received. So what we are doing here is we are buying one future and we are selling one ITM call option. Maximum loss would be unlimited, and the maximum profit would be the time value of the call option at the time of entering. So this would be the maximum profit. So let's understand here this with an example. Suppose if somebody bought Reliance Industries future at 820 and Reliance call option of 820 short sell at the rate of 30 rupees. So the break even point would be 820 minus 30 is equal to 790. If price of that Reliance falls below 790, then we have to make an exit and we have to book the loss, whatever the loss we are incurring in that strategy. Now there are situations explained here. First, if the future crosses below 790, loss will increase substantially. The second situation, if the future closes at 820, then the profit will be the maximum, because here we are just eating the time value, that is 30. So if it expires, if the strategy which we made by short selling the 820 call option at the level of 30, if the market expires at the level of 820, then the value of 30 will become 0 because it only has a time value. So this is one way of making a strategy, and this is one way to understand how we can incur the maximum profit. Now in the third situation, if future closes in between 830 to 850, the profit will be 30 points, because 10 points in future appreciation, because we bought, suppose market closes at above 830. So what we are going to gain here in this strategy is profit will be 30, 10 points in future appreciation, because 820 we bought, the Reliance future we bought at 820, and if it closes at 830, 10 points would be into our account. And same way, this 30, if it closes at the level of 830, since we have short sell this 820 call, so the basic value of that 820 call would be 10 points. So the loss would be 10 points in case if Reliance future closes at 830. So 20 points would be the profit in case Reliance closes at 820, or sorry 830. So 10 points in future and 20 points in cash. So net profit would be our 30 points depending upon the closing. So this is how we have to understand, and this is how the situation can be understood by taking the example and by putting the value in their respective field. So this was about covered call option. Now the next strategy is covered put option. A covered put option is selling future and selling ITM put option. Now this is used when market is trading in range, or then market is trading slightly mildly bearish. A break-even point can be achieved by future price plus the premium received. The maximum loss would be unlimited, and the maximum profit in this scenario will be time value of put option at the time of entry. So let's understand this covered put option strategy. We are taking just a previous example. Now how we have to understand it. We suppose short sell Reliance future at 820. What we did also, we also short sell 820 put option at the rate of 30 rupees. The break-even point would be on the higher side. If the stock price goes above 850, then we should immediately close our position and book the loss whatever we are incurring in the strategy. Now three situations are explained in here. First, if future crosses above 850, our loss will increase substantially. We should not hold our position at any cost. Second one, if future closes at 820, the profit will be the maximum. Again, it expires at the ATM value, and since we have short sell 820 future put option, so it total entire time value would become 0, and since it expires at 820, so there would be no gain in future. The only gain we are getting is from time value expiry. So if the future expires closes in between 810 to 790, the profit will be maximum 30 points. So same way, we just have to understand like what would be our maximum profit if future expires at 810, what would be the maximum profit if the future expires at 800, and what would be the maximum profit if the future expires at 790. So here in this strategy, what we are seeing is, if the price goes in a range, if the price trades in a range or falls a bit on the lower side, so this strategy can be applied. So this is just the opposite of covered call option which we just discussed. This is just the opposite of covered call option, and we call it as a covered put option. next strategy is calendar spread. Now what is futures calendar spread? Now futures calendar spread are simply the future spreads that are simultaneously making a buy position and short position in near month and taking the delivery of the far month. So understand, future calendar spread is also known as a future time spread or future horizontal spreads. Means making a buy position in the current month and short selling far month contract. So if we just reverse this strategy, we can also call them as diagonal calendar spread. To understand, in a simple way, buying near month future contract and selling far month future contract is called a calendar spread, and the diagonal calendar spread would be reversed, like short selling near month contract and buying far month contract. Let's take here an example. Suppose this is a month of October, and October is suppose is the near month contract, and then October, then November, then December. So what we are doing here is, if we are buying a calendar spread, okay, means we are buying October future, which is called near month contract, and short selling December month contract, that is called far month contract. So this is how our combination would be prepared, or this is how our strategy will be prepared. Now the market expectation in this case would be, when we are expecting that the price of that stock would trade in a neutral range, or it has a very limited range. A break-even point in this case would be the far month contract, and when far month contract and the near month contract becomes equal. That is generally what we are seeing, that in current month contract and the far month contract near, there is always been a price difference. So whenever the price difference becomes equal, that is our break-even point. And the maximum loss in this case would be the limited loss, and the maximum profit is the difference between the contracting price of the far month and the near month contract. So this is the maximum profit which we can get here is. So generally future calendar spreads are any kind of future strategies consisting of future contracts of different expiration months of the same underlying asset together into a single position. So we can say future calendar spreads are designed to profit from the difference in rate of movement between the near month future contract and the longer term future contract, and hence we can say therefore much less volatile positions can be made in this future positions. So we can basically we can understand it with a simple example. Suppose we just took an example at the starting of this strategy. If we, this is a month of October, we what we will do is we will buy October month contract and we will short sell December month contract. So this is how we will benefit from this particular strategy. So future calendar spreads can be considered as a long term, or are generally is a near term future contract and the short term longer contract, and when the price of these starts contracting, that is how we can get the profit from it. So this is the basic concept of the calendar spread. If we just reverse the position, it will become a diagonal calendar spread. So in calendar spread, the maximum profit is restricted to the narrow down factor of these 2 month contract. So if the gap between these 2 months contract will become zero, then the trader makes the maximum profit, and if the gap starts increasing, then our loss would comparatively would become wider, but the loss would be limited even in that case. So this is how we can make a calendar spread strategy, and the diagonal is just the reverse. Generally we make this strategy when we are expecting that market would be trade in a range market. Now the next strategy we also call as an arbitrage opportunity. Now how we can say it's an arbitrage opportunity? When we are doing is, we are taking a long position in cash market or spot market and short selling the future underlying. Say for example, if suppose Tata Motors, if we take an example of Tata Motors, suppose Tata Motors in cash market is trading at the level of 300 rupees, and same time the Tata Motors future is trading at the level of 303 rupees in future market. So what we are going to do here is we are buying Tata Motors in cash and we are short selling Tata Motors future of the current month. So in this way we can benefit the 3 rupees difference, buying Tata Motors at 300 rupees and short selling Tata Motors future at 303. So the 3 rupee difference would be our arbitrage opportunity, which we generally encash. So the quantity should be same. Suppose Tata Motors future contract lot size has a 1,000 shares, so we have to buy 1,000 shares minimum or in the multiple of 1,000 shares in cash market too. So if you're buying 1,000 shares in future market, so we have to buy the equal number of Tata Motors 1,000 shares in cash market. So buying in cash market and short selling in future market, that is called, the difference is called our profit, because we know that the expiry of the future contract would based upon the cash market. Our loss would only increase, our loss would only be in the case when price of cash market and future market starts widening. But it happens very rare that say it starts or it goes above the 1% or 1.2% rate between the cash market and the future market. So generally there is a price difference of maximum 1% or 2.5% in the pricing of cash market and the future market. So this is the one way we can arbitrage, find out the arbitrage opportunity, and this is a risk-free profit. So generally these kind of thing is generally we found in the arbitraging opportunity in the same price in the same stock. So what we know is cash market and the future market, that expiry of the future market would always be happen on the basis of cash market. So this is how, when the difference between the cash market and future market starts contracting, so we will start getting into the profit. So maximum profit in this case would be our 3 point. So here in this strategy, we apply this strategy when the market is trading in a range bound, and the break even point would be is equal to spot price is equal to future price, and maximum loss would be limited. Only loss will increase when the price starts inflating. The maximum profit becomes when the gap starts filling and the cash market and the future market becomes equal. So this is how we can also find out the opportunities in cash market and the future market, and you can easily find out these kind of opportunities in plenty of stocks these days. That's why we term them as an arbitrage opportunity trading. The next one is called long index stocks and short index. Now, what is long index and short, long index stocks and short index? This is also a kind of strategy. It's a very simple hedging technique in which what a trader do is the trader buy all the index security in the spot market and sells one lot of index future. So what are the benefits of this strategy, when and one a trader should apply this strategy? This is the best technique for the index hedgers, like by the way of buying the entire index script, and the trader takes the risk of amount equivalent to the index value. So this kind of strategy is like, what we are doing is we are buying the entire index stock and we are short selling the index. So whichever index we are buying, suppose if we are buying Nifty we are short selling Nifty index, then what we are going to do is we will buy all the script available in the Nifty 50. So that application buying of all the stock would be based upon their market capitalization. So it is bit difficult for a retail trader to understand this concept, but this is a one way. If somebody can understand this concept, they can apply this concept. But risk reward ratio in this strategy would be very minimal, or it's a very low rewarding strategy, so that's why we are not giving any important focus on this particular strategy. Now the assignment for you people after this module 2, you have to submit all the strategies which we have covered specifically in this module. And to understand the better market analysis, just go to the NSE website, and there you would be finding 22 strategies explained there. So just try to understand those strategies and try to work it in a basic scenario on the basic market functioning of those things. And the second one, prepare a strategy for the month or for any month. Like if suppose you are enrolling the course in the month of October, just try to understand the concept and try to find out the range of the October month, and then try to explain the strategies which we have just discussed in here. Or you can also alternatively do one thing, that evaluate the strategies which we have discussed over the historical data over the from the NSE website, and try to find out and try to apply those strategies and how effectively can be done in a real manner. So take the data from the Bhav copy, and you will be able to understand, you will be able to work out those strategies in a better way. So this was about our module 2. Hope you liked it.